Hey everyone, welcome back to Corporate Decoder. Today we are diving into the Advent Convertible and Income Fund's semi-annual report. And let me tell you, it's a wild ride of managed assets and convertible securities. It is so strange that you might think it was written in a foreign language. So get ready to decipher what's really happening with this investment fund. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come and join us. Let's see if the fund made a profit or loss during the 6 months. The report covers the 6-month period ending April of 2025. Let's cut to the chase and discuss something everyone cares about, money, or should I say key financial figures. This report says that the net increase in assets resulting from operations are 8,000 on 40 Olev and 4096. It sounds like a lot until we realize that they manage over 5 on 11 million. This means that they made only 1.5% in 6 months. Not very impressive 11 million. This means that they made only 1.5% in 6 months. Not very impressive. Let's see if it was worth it and if the gains were higher than the dividend distributions, since most people investing in it are most likely seeking to benefit from the dividends. The report says that for the same period, the total distributions to shareholders were over 31 million. That is a pretty important difference. They paid more than they earned. Now let's check the fund's actual performance. Over the 6 months, its net asset value rose 1.38% on a non-annualized, meaning that it grew less than 1% in practice. Meanwhile, the Bloomberg US Aggregate Bond Index grew twice as much in the same period. The S&P 500, a broad stock market index, dropped 1.75%. It just says what direction they are aligned to, not how successful are they. And let's see which assets this fund is managing. The report indicates that a major chunk of their assets is in corporate and convertible bonds, specifically 67.8% in convertible bonds and around 64% in corporate bonds. This tells us that they invest a lot of bonds. Bonds are generally considered more stable but yield less. These numbers help you understand how this fund is positioned. Most of the money, 80% to be exact, is invested in US securities, making it very dependable on the US situation. The rest is scattered through tax heaven. Let's explore the dividend distributions history, which is what most investors care about. We can see that on each month the TOEs per share. That represents an annualized approximated dividend rate of 12.65%. That means that for every 100 invested, you will get back roughly 12.65%. That means that for every 100 invested, you will get back roughly 12.65 a year. If that payout is maintained, and I see if that's obviously really high and has lots of risk involved. Let's see the team responsible for it. Maybe we can get some clues there. The fund is managed by a team at Advent Capital Management LLC. The key players are Tracy Maitland, Paul Latronica, and Tony Huang. With so much at stake in those distributions, understanding who makes those decisions becomes even more crucial. Let's read a few excerpts to understand what happened during the period. The document starts with an economic and market overview. It mentions increased volatility due to geopolitical factors. Here's the thing. The US presidential election had investors excited about potential tax cuts and deregulation. Corporate profits grew, which helped the market early on, but when policies shifted towards higher tariffs, that excitement cooled down. The Federal Reserve lowered interest rates, but long-term interest rates actually increased because international capital started fleeing. Budget deficits were high, and people feared the tariffs would cause even more inflation. This made it tougher for corporate bonds, which had already had a good run. This caused them to drop and erode coupon income. That is never a good sign. Interestingly, foreign equity markets actually started doing better as concerns about the new administration's policies grew, so capital flowed back into international markets. Later in the report that the fund's returns roughly matched the largest asset classes, domestic convertible securities and domestic high-yield corporate bonds. The fund increased exposure to foreign convertible securities and CLO securities, helped offset fees and interest. Then it adds that despite risk-free rates falling and treasury yields rose, concerns kept growing over the impact of a slowing global economy and on corporate profits. That means price declines for the high-yield assets. Then it says that the fund uses covered call options to generate income. As more uncertainty raised, the implied volatility of options increased to 1/3. The fund has increased their use of covered call writing strategy at the end of the fiscal first half to capitalize this. Interestingly, in this same section, it adds that the fund utilizes leverage to finance the purchase of additional securities. The fund had $350 million in leverage. The average interest rate was 4.61%, lower than the 4.90% average previously. It's good to see that the cost of debt is decreasing for the firm. International investments decreased. Even though interest rates are lower in foreign currencies, their hedging program takes money out of the equation. So in terms of winners and losers, convertibles and European defense supplier Rheinmetall AG surged after the turnover in US administration led to policy changes among European countries on defense spending. Mandatory convertibles in gas infrastructure provider Chart Industries rose after a strong quarter thanks to policies supporting natural gas. Among the detractors, convertibles in cruise line operators Carnival Corp and Norwegian Cruise Lines declined as fears increased as free cash flow decreased. Now let's look at those forward foreign currency exchange contracts. We see that the fund is buying and selling euros and Japanese yen in millions, hoping to profit from the exchange rate changes. However, the summary says that the total NT depreciation is $1.7 million. Most financial advisors use different levels to classify their risk and effort to determine the fair prices. Level 1 is the most trustworthy because it uses real prices from active markets. Level 2 relies on similar things but might need some adjusting. Level 3 is very tricky with estimates instead of real data. And here we can tell that they really rely less on what they know, which is level 3. Think that was a lot, right, CR? Now let's get to the raw conclusion and judgment and get something very clear. The Advent Convertible and Income Fund has some serious challenges. While there's a lot of assets being managed, they can't distribute enough dividends. The asset performance is not very good with their strategy. It also relies too much on external factors. However, it's definitely a high-risk investment, especially with the high dividend. High dividend means high risk. A key risk to consider is the amount of investments deemed illiquid. Risk of bankruptcy, or will have to change strategy very quickly. And my conclusion is that this fund is unsustainable in the long term. It's either at risk of bankruptcy or will have to change strategy very quickly. Unquote. I shall break down of Advent Convertible and Income Fund's latest filing. What's your take on these numbers and what they signal for the fund's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more financial deep dives. Also check out the Discord in the description. See you next time.